everybody. My name is Winfried Heinrichson, and this is part 3 of what operations managers should know about financial statements. Today we have to talk about the difference between expenses and cash flow. Let's again start with a timeline. During the business year, the hotel orders supplies for $2,000. The supplies arrive, and the hotel pays the supplier right away. How would that appear in the financial statements? The supplies increase the inventories in the balance sheet, and the cash position decreases. We would also find the decrease in cash in the cash flow statement as an operational cash outflow. But there is no expense yet. The money is gone, that is true, but instead of the money, the company now has the inventories. The net effect on the company's wealth is zero. The company is not richer or poorer by buying stuff. Why is this not an expense? The expense happens when inventories are used up or sold, because then the company does not own them anymore. The expense stands for values lost because they are given away to the customer. From that, we can learn an important concept in accrual accounting in general and in the income statement in particular, which is called the matching principle. Most income statements employ a structure that starts with two line items, the first being sales revenues, or simply sales, and the second one being cost of sales, which is an expense. And the cost of sales is the purchasing value of what has been sold to the customer. So when the material was purchased and paid at some time in the period, that is not an expense. We already learned that the revenue is realized when the service is performed or the product is delivered. Likewise, the expense to that service is the direct cost associated with that service. So if a service has been provided for $2,000 and the materials to provide that service were purchased for $400, then these two numbers refer to the same business transaction. The 2,000 are now a sales revenue, and the 400, which are the cost of providing exactly this service, appear as the cost of sales in the income statement. The expense of 400 is what the company had to sacrifice in order to make that revenue. That is what the matching principle is about. So the income statement does not simply show materials that have been purchased during the year. The income statement shows the cost of providing that service, including the materials that have been used or sold, and the personnel expenses that have been incurred to provide the service to the customer. As long as the materials or the products are not sold or the service has not been provided, the cost of these will not appear in the income statement. Let's continue with an example that involves personnel expenses. This example is about an expense in one period with the cash outflow in the next period. Let's say in December 2019, the company has not yet paid some employees for their working hours in December. The salaries were paid in January 2020, the following year. What would happen in the financial statements 2019? On the asset side, nothing happens. No money was paid. But in the income statement 2019, something happens. The matching principle requires that the cost value of the working hours, the salaries, incurred in December, helping to generate the December revenue, must be December expenses. So don't ever think that you can pimp the 2019 profits by paying late. The expense is always when resources have been used. It only saves liquidity to pay late. It won't help profits. So the expense reduces profit and therefore equity. And since the salaries are not yet paid, a liability has to be recognized. We can call that a salaries payable, to show that the company owes salaries to its employees in the amount of what has not been paid yet. Please note that the balance sheet totals are unchanged. In a way, the 3,000 have been taken away from equity and transformed into a liability. The next year, the salaries are paid, the cash is gone, and the liabilities are settled and disappear from the balance sheet or from the accounts. And the cash flow statement shows a cash outflow from operations, but there's no effect on the profit of 2020. Last example for today: depreciation expense. You may already know that long-term assets which are subject to wear and tear have to be depreciated over their useful life. Machinery, furniture, technical equipment or cars are typical examples. Let's assume at the beginning of 2020, 30 mattresses for 30 beds have been purchased and that each mattress cost $400. So the investment at the beginning of 2020 is 400 times 30 is $12,000. Let's also assume that hotel management decides that mattresses are to be replaced every 3 years. So a mattress is a long-term asset with a useful life of 3 years. In the balance sheet or the accounts, this investment would increase PPE, property, plant, equipment, by 12,000, and if paid right away, cash decreases by 12,000. In the cash flow statement for 2020, the cash outflow of 12,000 will appear as a cash flow, a negative cash flow, but a cash flow from investment activities. Keep in mind that investment activities, investment cash flows, refer to tangible or intangible or financial assets, all of which long-term, which means those acquisitions meant to be used by the company for more than 1 year minimum. Please note that again, the acquisition of assets, the purchase itself, doesn't make the company any poorer, so it is not an expense. The 12,000 do not appear in the income statement. Finance people would look at this and say, the structure of assets has changed, but not the wealth of the company. The company has less money, but now they have mattresses. At the beginning of 2020, the company has put the 12,000 in the accounts, in the balance sheet as PPE. If the company expects that the mattresses will be used for 3 years, they will depreciate the mattresses over 3 years. And this is how it works. Divide the 12,000 by the years of useful life. In our case, 12,000 divided by 3 is 4,000. And put the 4,000 in each of the following income statements as a depreciation expense, reducing profit by that amount. Again, the idea is to put the expense against the revenues that these expenses help to generate. After all, the mattresses are part of the service provided to the customer. The costs of these should be put against the revenues that they help to generate during the years in which they are used. Of course, this also has a consequence in the balance sheet. At the end of 2020, the depreciation represents a loss in book value. The carrying value of the PPE is reduced by 4,000, from 12,000 to 8,000, and the expense reduces profit and therefore equity. So both sides of the balance sheet decrease by 4,000. And the same happens in 2021. The PPE book value decreases by 4,000, and so does equity. And the same again in 2022. At the end of 2022, the mattresses should be fully depreciated. So what is the takeaway from these examples? Income and expenses and cash flows can be identical, but often enough they are not. The profit is not a bag of money. Profit represents the amount by which the company has generated wealth. Keep in mind, the profit can only be paid out to owners under 2 conditions. The necessary condition, There have to be profits determined in the income statement, which are either current profits, profit of the year, or retained earnings, which are undistributed profits from previous years. And the sufficient condition: the company must have the cash to actually pay those dividends. If they don't have the cash, they cannot pay out anything. It's that simple. So that's it for today. Thank you for watching. If you want me to clarify anything or to address a different topic, a topic to make a video about, just write something below in the comments. I'll be happy to see what I can do.